Today we are talking about a company everyone wanted to believe in. Enron wasn't some obscure business hiding in the shadows. It was huge, powerful, and admired. Wall Street analysts praised it. Investors trusted it. Employees wanted to work there. And its executives were treated like financial geniuses. Enron seemed to have discovered the future of business. It was making enormous amounts of money. Or at least, that's what everyone believed. Because behind the impressive profits was something much harder to see. A system designed to make Enron look more successful than it really was. And for years, almost nobody could see how the illusion worked. So how did Enron fool so many smart people? To understand that, we have to go back to the beginning. Enron's story begins with a man named Kenneth Lay. Lay wasn't a mysterious outsider. He was a respected energy executive. In 1985, he became the head of a new company called Enron. It was created by merging two natural gas companies. At first, the business looked ordinary. It moved energy through pipelines. But Lay saw something bigger. He believed energy didn't have to be sold like a simple commodity. It could be traded, just like stocks. That idea would transform Enron, and eventually, it would help turn the company into a financial powerhouse. Lay also understood something else. To build a giant company, you needed powerful friends. Enron built relationships across Wall Street, Washington, and the energy industry. Soon, Enron wasn't just selling energy. It was becoming a force in American business. And then, Kenneth Lay brought in the man who would change everything. Jeffrey Skilling. Jeffrey Skilling saw Enron differently. He didn't want Enron to simply own pipelines. He wanted it to become a marketplace. A place where energy could be bought and sold like stocks. The idea was revolutionary. Instead of waiting years to make money from an energy project, Enron could trade contracts around that future money. And Skilling believed this model could go far beyond energy. Gas, electricity, oil, even internet bandwidth. If something could be turned into a market, Enron wanted to trade it. And Wall Street loved the idea. Enron was no longer being seen as an old energy company. It was being presented as something completely new. Faster, smarter, more sophisticated. But there was a problem. The more successful Enron appeared, the more its stock price mattered. And that created enormous pressure. Because once Wall Street expects you to keep growing, you can't simply stop. You have to keep producing the numbers. And that is where Enron's real story begins. Now we need to understand one simple idea. How could Enron keep showing huge profits? The answer was an accounting method called mark-to-market. The name sounds complicated. The idea isn't. Imagine you sign a contract today. You expect that contract to make you $100 million over the next 10 years. The money hasn't arrived. You haven't collected it. But Enron could estimate the future value of that deal and record much of that expected profit today. On paper, the company suddenly looked richer. And the bigger the future profit looked, the bigger today's reported earnings could become. There was just one problem. Those profits were based on estimates about the future. And the future hadn't happened yet. But investors saw the numbers. They saw the profits. And they saw Enron's stock price rising. The illusion was becoming reality. At least on paper. And now Enron needed even more deals to keep the illusion growing. But there was another problem. Enron was taking on enormous amounts of debt. And debt creates an awkward question. If you're becoming richer, why do you need to borrow so much money? Enron needed a way to keep that debt from frightening investors. This is where Andrew Fastow entered the picture. Fastow was Enron's chief financial officer, and he developed complicated financial structures called special purpose entities. The name sounds intimidating. The basic idea was much simpler. Imagine your house is filled with debt. Instead of showing everyone that debt, you create another house. Then you move some of the debt into it. Your original house suddenly looks much healthier. The debt hasn't disappeared. It has simply been moved somewhere else. That was the basic logic behind some of Enron's off-balance sheet structures. Investors saw a company that appeared financially strong, but behind the scenes, Enron was carrying far more risk than the public understood. And the more debt it hid, the more important those financial structures became. The illusion was no longer just about profits. It was now about hiding the price of creating them. By now, Enron had a problem. The company had created enormous expectations. Wall Street expected growth, investors expected rising profits, and Enron's stock price depended on those expectations. So the pressure became constant. Every quarter had to look better than the last. But real businesses don't grow forever. Projects fail. Markets change. Profits disappear. Enron needed another solution. It began using more complicated deals, more aggressive accounting, and more ways to keep bad news away from investors. And this is where something important happened. The people inside Enron weren't just hiding problems. They were being rewarded for making those problems look smaller. The company became obsessed with one thing: performance. Employees were ranked against each other. The strongest performers were rewarded. The weakest could be pushed out. It created a culture where everyone learned the same lesson. Winning mattered, and admitting failure could be dangerous. So the pressure to keep the story alive wasn't coming from one executive anymore. The entire organization was beginning to feed it. Inside Enron, success wasn't just encouraged, it was measured. Employees were ranked against each other. The best performers were rewarded. The weakest performers could be pushed out. It created an intensely competitive culture. Everyone wanted to be seen as a winner, and nobody wanted to be the person who said, "Something is wrong." Because at Enron, bad news was dangerous. If a deal was failing, find a way to make it look successful. If profits were disappointing, find another deal. If debt was becoming a problem, find a way to move it somewhere else. The company had built a system where good news was rewarded and bad news was punished. And that changed the question employees were asking. It wasn't always, "Is this true?" It became, "Can we make this work?" That difference mattered, because eventually, Enron took its financial engineering into the real world, and ordinary Americans were about to pay the price. Then Enron found a market where the stakes were much higher: electricity. In California, the energy market had been partially deregulated. That meant electricity could be bought and sold through a more open market. Enron saw an opportunity. And when electricity became scarce, prices could rise dramatically. Enron traders discovered they could profit from those conditions. They could buy power, hold it back, move it between markets, and take advantage of price differences. California began experiencing severe electricity shortages. Power prices soared. Businesses struggled. Families, by the early 2000s, Enron's numbers were becoming harder to explain. The company was reporting enormous profits, but its finances were becoming increasingly complicated. Then someone inside Enron began asking questions. Her name was Sharon Watkins. She was a vice president at the company, and she noticed something deeply troubling. Enron had created complicated financial partnerships, some of them connected to its own executives. The arrangements were difficult to understand, and that was exactly the problem. If even people inside the company couldn't clearly explain where the risks were, how could investors possibly understand them? Watkins became increasingly worried. She eventually wrote directly to Kenneth Lay. Her message was essentially a warning. Enron could be heading toward a disaster, but the warning came at a critical moment, because by then, the company's image was already enormous. Thousands of employees depended on it. Investors had billions of dollars tied to it, and Wall Street had spent years believing in it. The question was no longer, "Is something wrong?" The question was, "How much is wrong?" For years, Enron's stock price had helped protect the illusion. As long as investors believed, the company could keep raising money. But confidence is fragile. Once investors started questioning the numbers, everything began to change. Analysts started asking harder questions. Where were the profits coming from? Why was Enron carrying so much debt? And why were its financial structures so complicated? Enron's executives kept reassuring the market, but the stock price began falling, and then it fell faster. The problem was simple. Enron needed confidence to survive, but every falling share price created more doubt, and every new question created more selling. The machine began working in reverse. Employees watched their retirement savings disappear. Investors watched billions of dollars evaporate. And the company that had once seemed unstoppable was suddenly fighting for its life. Then came the moment Enron could no longer hide. The numbers were finally catching up with the story. By late 2001, the game was over. Enron could no longer convince investors that everything was fine. Its stock price collapsed. Billions of dollars in market value disappeared. Employees watched their retirement savings vanish, and thousands of people lost their jobs. Then came the final blow. Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. But Enron wasn't the only thing that collapsed. Arthur Andersen, the accounting firm responsible for auditing Enron, was also destroyed by the scandal. And suddenly, the company that had been praised as one of America's greatest innovators became a symbol of corporate fraud. But there was still a bigger question. How did something this enormous survive for so long? Because Enron didn't operate alone. There were auditors, banks, analysts, rating agencies, regulators, and powerful political connections. Not all of them were deliberately corrupt, but too many people had reasons to believe the story, and too few had reasons to stop it. Enron didn't build this illusion alone. Around the company was an entire financial ecosystem. Auditors, banks, analysts, rating agencies, regulators, and powerful political connections. Each played a different role. And not everyone involved was knowingly participating in fraud. But the system had a serious weakness. Almost everyone had something to lose if Enron failed. Take Arthur Andersen. It was one of America's most respected accounting firms. It was also being paid by Enron. That created a dangerous conflict. The company being audited was also an important client. Then there were the banks. Some helped Enron create complicated transactions. Some of those transactions made the company's finances look healthier than they really were. Analysts had another problem. Being too negative about a major company could cost relationships and business. And regulators? They were supposed to protect the system. But they didn't stop Enron before the damage became enormous. This doesn't mean every person in that chain was corrupt. It means something more complicated happened. The incentives were pointing in the wrong direction. People were rewarded for believing the story. While challenging, it could be costly. And when everyone has a reason to look away, a dangerous illusion can survive for a surprisingly long time. Enron is often remembered as a story about fraud. And it was. Executives made decisions that destroyed a company. But that isn't the whole story. The more disturbing lesson is how long the illusion survived. Enron had smart executives, smart accountants, smart bankers, smart analysts, smart investors, and still, the system failed. Because intelligence doesn't protect people from incentives. People tend to believe what rewards them. Investors wanted rising stocks. Employees wanted bonuses. Banks wanted business. Analysts wanted clients. Auditors wanted fees. And Enron wanted everyone to believe it was winning. So the illusion kept growing until reality became impossible to hide. That is why the title matters. The smartest guys in the room weren't necessarily the people who knew the most. They were the people who understood how to make everyone else believe. And perhaps the most important lesson from Enron is this: when everyone profits from believing a story, the most dangerous person in the room may be the one who finally asks, "Is it actually true?"